Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have a returning guest. He is Jason Barak. He's over at wallstreetformainstreet.com. Thanks for coming on again, Jason.
Thanks, Rahul. Glad to be back.
All right, the number one topic in the minds of all these guys listening to us is what on earth is happening with gold? I've asked this to all my guests. And right now, yeah, there's been a sharp rally ever since that smackdown near the Boston Marathon date. I think it's trading around 14.50. I don't remember the exact price right now, but it's been going up. So you think that there could be another smackdown? I mean, I saw in one of my emails, I think John Rubino said that, hey, there could be another smackdown coming soon.
There could be another drop in the paper price because it's the paper market, and the paper market is becoming literally this dislocation just increases more and more seemingly every day. We are near the point though where the physical supply of the gold and silver is we're having legit shortages. The premiums are rapidly rising. The miners are in a lot of financial trouble right now. This price going back up has been a little bit beneficial to them. But when gold and silver drop below key support levels for gold at 15.25 and silver at 26, the miners, a lot of them became in the danger zone, I like to call it. Literally when prices were at that high above, when gold was around 1,600 and silver was 28 to 30, a lot of these miners were not generating that much free cash flow per ounce. Their earnings were not good. For a lot of gold miners, they were barely generating $200 an ounce in free cash flow, if that. For a lot of silver miners, they were barely generating $5 an ounce free cash flow, if that, for many of them. So the price is going lower and lower, Raul. It's gotten to the point where, especially when gold dropped down to like 1350-ish, and silver dropped down to around 23, where a lot of mines switched from cash flow positive to cash flow negative or barely break even at all. Some of the mines are even extremely cash flow negative, the higher cost producers, and those guys have so much leverage, so much debt on their balance sheets, and they didn't have that much cash on their balance sheets. So this is not a good situation because their stock's already down 80%. It's not a good idea for them to sell more shares. If they sell more shares or even call two investment banks to say we're thinking about diluting our shareholders and issuing more equity, the stock's down another 20 or 30% just on the rumors because those investment banks, they tell a couple hedge fund manager friends that, hey, so-and-so is going to, raise some equity or thinking about it, go and short the stock. And, there's a lot of insider trading in the market. So basically, Raul, the takedown, it was a combination of manipulation, and then what happened was gold and silver have failed to break out over the last 6 to 8 months. We've done a lot of podcasts in the past, interviewed a lot of other gold and silver experts. On the charts, gold and silver and the mining shares were very, very close to breaking out 3 or 4 times in the last 8 months, really since August of 2012. There were really good cup with handle continuation patterns that were saying breakout was close, and literally every time gold and silver and the miners were about to break out, they just got smashed at overhead resistance levels. And then, literally, when that happens, Raul, the trend traders, the Wall Street traders who don't give a crap about fundamentals, who don't know anything about fundamentals at all, they think everything people need to know is contained in the charts and the technicals. They see the false breakouts and they see that as weakness. So when that happened a couple times in a row, Raul, those guys started to go short. And from then on, in February and other months like that, you just saw all these negative research reports come out from investment banks, and it was obvious they were all going to start shorting it, or at least try to short it. But the physical market was so strong, there was still a good amount of demand at that point. But on April 12th, which was the first drop-down day, Raul, over 100% of of gold mining supply for 1 year was traded in 1 day of paper. That is insane. Okay, that's not how a real market should work. That is just insane. There is no need whatsoever, and it's happened all the time in silver too, where 1 year or more of total mine supply is traded 1 day. Why? Why do we need to do this? This is only creating more volatility that hurts the miners. I mean, this is going to prevent what has happened, with these paper price smackdowns has hurt the mining industry so bad in the last couple of years. There are going to be a lot of companies now that will not be able to even raise a couple $1 million, especially the juniors. The junior market is pretty much done after this.
If the junior market is done after this, won't there be a few stars, and then these star miners, or they could be streaming companies, that's where all the hedge fund money will eventually go when we know that spike's going to come. I don't know when that spike's going to come. That's where I see all this hot money flowing in.
There will. I agree with you on that. There's going to be survivors. It's survival of the fittest. All the fat has been trimmed from the sector now, Roll. Almost all the fat. The larger miners, they've routinely missed earnings. They've overpaid for projects massively. They bought a bunch of large ounce deposits that were lower in grade, very high capex projects that you look at Barrick and Pascua-Lama, and the majority of Barrick's reserves, now the gold price has dropped. Not the majority, but I would say over 30% of Barrick's reserves are no longer economic. So they've overpaid for these expensive future deposits with massive gold reserves, and none of them are going to be economic at these levels. And the Barrick CEOs are overpaid. They paid themselves. They had humongous pay increases, even though the earnings dropped massively, and the stock price is down more than 50%. That is waste. That is corporate waste, and it's going to take some time for the larger companies to fix themselves, because the larger companies and the juniors, the really small juniors, are where all the waste have been, in my opinion. The real sweet spot in the market is those junior producers, those mid-tier producers, because those guys haven't had access to the debt market. They've been run more efficiently. A lot of the management teams have large insider ownership of the companies, and the most efficient part of the industry is the royalty and streaming companies. Those guys, the royalty and streamers, are only going to increase in amount of companies, because that's the most efficient way to finance these future mines and stuff like that. And I really don't see, there's only 4 of them, and I don't see those guys going bankrupt. They're just too sound. They generate free cash flow. They spend many months doing research and proper due diligence on deals to make sure they're partnering with a management team that has really good mining experience bringing a mining online, low-cost producers, et cetera, et cetera.
And for those in the audience, what is free cash flow again? Is it EBITDA minus capital expenditures?
That's the technical definition. The more simplistic way to say it is, well, first of all, you can split up free cash flow into what is your maintenance capital. So how much money does it cost for the business to be maintained? And this is one of the problems with mining is a very capital-intensive business. So literally you're depleting your reserves. You have to replace your reserves because the mine could run out of ore to mine eventually. And then you're borrowing a lot of debt on the balance sheet to do it, to bring a mine into production, or you're diluting your shareholders because there's capital overruns. There's a lot of moving parts in a mine, et cetera, et cetera. So this is where the royalty and streaming companies are by far head and shoulders more efficient than the rest. But in general, though, you have maintenance capex, which is not part of free cash flow, which takes it away. And then you have a growth capex. So free cash flow is going to be subtracting any maintenance capex there. And free cash flow is used for growing the business, for growth capex. It's used for paying dividends. It's used for buying back shares. It's not used for paying off debt. So the free cash flow is all the stuff that basically adds to the shareholders' equity in a beneficial way. So it's retained earnings and other things like that.
All right, moving forward, I wanted to go into the stock market. And right now, there's all this talk in the alternative media that, hey, we're going to get a crash here and there. And my thoughts are, okay, if the Fed continues to print all this monopoly money and will not unwind the balance sheet and will not raise interest rates, well, this phony recovery or this recovery in the stock market will continue. You're going to see the stock market go up. It's not going to go up in a straight line. You're going to have breaks here and there, but I just see more hot money going to the stock market because of what the Fed's doing and what other central banks are doing.
Yeah, I would agree with those points. Let's talk about a few different things first. First, let's talk about flow of funds. I think what you're seeing now, Raul, is over the last 6 months, you've started to see a lot of cash, a lot of people, money managers, institutions, sovereign wealth funds, very high net worth individuals that after 2008, 2009 and the crash, right, they said they were going to never buy stocks again. And yet the stock market has done very, very well really since 2009 in general. And those guys, they've had their money in cash, they've had their money in money market funds, maybe they had their money in a little bit of bonds, low interest bonds, and those markets have not done as well as the stock market has. So what you're seeing now is you're starting to see that money start to rapidly go into the stock market. Now, it's not going into the very, very high-risk stocks yet. You're not seeing large flow of funds into the small caps, the more aggressive small caps and stuff like that. The leading sectors for this stock bull market really since 2009, and this is not a purely fundamental stock bull market, okay? This is a liquidity-driven, financially engineered, not just by the Federal Reserve, but all global central banks because they're all printing money either off dollar pegs or other stimulus programs of their own QE. And the leading sectors for this bull market, Raul, have been healthcare, utilities, consumer staples, and those oil and gas master limited partnerships. Those are all historically high dividend yield paying industries, okay? So these are all types of things that people use every day. These are not necessarily the high-risk assets, things like that. So those are the types of investments where the valuations have started to run up pretty high, and I think this is going to continue. I just don't see as much risk right now for specific stocks. Surprisingly, a lot of the flow of funds and the money on the sideline has not gone into commodities lately, although I think it's going into physical bullion purchasing right now. But it just hasn't really gone into the commodities markets, like in general for the commodity-producing stocks and stuff like that. But the fundamentals of the stock market, though, are very, very dicey. Okay, let's talk about that and what makes sense and what doesn't. Okay, here you have a consumer here in the United States, right? Their discretionary spending may have peaked, okay? So their food bill's going up, their gas bill's going up, although the gas prices have taken a little bit of a break, but it's obviously the trend is still much higher. Their education costs are going up, their healthcare costs with Obamacare and all the other inefficiencies, those things in general are still going to be going up. And here you have them, in a lot of cases with their employment situation, they're either working harder for less money just to keep their job, they're working multiple part-time jobs to survive, or, they can't find a job at all and they're trying to burn through savings, or they're running through their credit card debt, or they're, putting a second mortgage or something like that on their homes. So we're not really to the fundamentals, Raul, where there's real growth in the economy, or there's real job growth and stuff like that. Now, the corporations, American corporations, to their credit, and this is why profit margins are so good, after the 2008 crash, right? Corporate America in general, the CEOs, a lot of CEOs here in the United States are really, really good at their jobs, okay, besides the mining industry. But that's another topic for another day, or maybe later in the podcast. But anyways, though, the regular corporate America CEOs slashed expenses to the bone. We're talking they switched they cut a humongous amount of jobs. They moved people from full-time to part-time because they saw, Obamacare and all these other things were going to be implemented. They started switching to more robots, software upgrades, and other technology improvements that maybe could cut back on the amount of physical employees so they don't have to pay benefits and all these other things. In general, for a company and for shareholders, that's a good, efficient thing. Now, it's not good for the employment situation in the United States, but that's how free markets work. So anyways, though, that's not good for the whole U.S. economy because we're just not really seeing the job growth. So the companies are going to survive, and that's good for them because they're getting lean and mean in a lot of cases, although there are some sectors like healthcare, the banks, real estate, home builders, those types of guys who are getting more and more free money from the government. But I'm talking the guys who don't get free money from the government because those guys were forced to, be lean and mean, cut things to the bone, run things efficiently. That's how you survive long term. You ride out a storm. And, these guys have had really good profit margins. Now, I don't know how well their profit margins are going to be going forward because the growth really is not there. There's not real growth, especially here in the United States for a lot of markets. Because like I said, the consumer discretionary spending is not increasing. It's decreasing, and I think it's peaked. And the developing markets, only some developing markets are doing pretty good. So the question is then, why is the stock market going to continue to go up? And I think we've talked about this a little bit. It's mostly going to go up because the money that is looking for yield that missed out, that was either in the bond market or in cash, it has badly underperformed, or they've seen the devaluations in fiat currencies from Japan and other countries. They're going to go into stocks because stocks offer better yields for the first time in many decades than the bond market does. That is insane. Okay, that really hasn't happened from a yields perspective, Raul, since really the 30s and 40s, where stocks offered better yields than bonds. And, stocks went up for a while then, and people didn't participate then either. So this is the type of things that we have. We have a very weird fundamental picture for why the market's rising. You have a lot of flow of funds, and then there's really nothing to stop the Federal Reserve or other central banks from just expanding the balance sheet again. There's a 15% correction in stocks or something like that. There's nothing right now to stop the Fed from expanding their balance sheet to 150 billion, 200 billion a month. And I think that's what's looking like. If we have a correction, Raul, that's going to be exactly what happens very soon.
That's insane, but if you look at it, the Fed is just going to put itself in a bigger hole and trying to unwind the balance sheet down the road. Well, have fun with that.
Yeah, I mean, the funny thing, Raul, I've spoken with a lot of Wall Street people. There's a really good website if you want to, your listeners want to gauge sentiment. It's an investing website called Seeking Alpha, and there's a lot of Wall Street analysts that post over there. It's free. And they could just gauge sentiment from the main Wall Street people who worked on Wall Street for a long time, and a lot of Keynesians over there, because there's not a lot of Austrian school people who post over there. And they're telling me, I don't believe them, obviously, because I know that the Federal Reserve cannot unwind its balance sheet that quickly. They're telling me the Fed can be out of all these trillions in assets. They're adding another trillion this year to their balance sheet. They can be out of all their balance sheet. They can reduce their balance sheet to almost zero in 3 to 5 years. I don't believe it.
They must be on crack if they really believe that. Maybe a little bit at a time, but all of it.
They also believe sorry to interrupt you. They also believe the CPI too, though. So
yeah,
they think the CPI is over-reporting inflation. So
yeah, there's no way for me to respond to that. It's just going to be an angry response. But I wanted now to get into the story of Japan, and we could call Japan the Keynesian. You could not nightmare. You could just say the Keynesian miracle, right? 20 years of slow growth, and now you have Abe in power, and the yen. Remember when Fukushima happened, the yen was, I think, 76, and then right now it's trading at 100. And you told me earlier when this was going down that they're talking about a 20% depreciation of the yen for many years to come to eventually get to that old number of 300 yen. So how are you looking at Japan right now? Do you see it constant at 100 on their trading index, or what?
Do I think that they don't want the yen devalued anymore? They're happy with it?
No, not happy. I mean, where do you see the yen going right now? Because if you look at, especially the yen, and then if you want to look at their bond market, it's at the 10 years right around maybe 60 basis points, right around there, and that scares the crap out of me, because if that yield goes to maybe 100 basis points or 150, 200, 250 basis points, they're in trouble, especially at the 250 basis point level, or if the 10 years trading at 2.5%. So how do you see the yen and their bond market playing out in the near term, and then probably within the next 3 to 5 years?
Okay, well, within the near term, the central planners in Japan and the people at the Bank of Japan and the Japanese politicians, I think they're doing a great job. Honda, Toyota, those guys, the Japanese exporters, because of this yen devaluation, there's been a massive increase in profits and sales at the margin from Japanese automakers and other Japanese manufacturers over Europeans, over European automakers and European manufacturers. So really what they think they can do, and in the short term, I've said this in past podcast role, it would actually look like it's working by printing all this money, is the Japanese central bank prints the yen, right? Then they buy up the bonds, their Japanese government bonds, because really the corporations and the private Japanese citizen are soaked in them. They're not going to buy them. In fact, those guys are now net sellers. And basically what's going to happen then is that the yields for the bonds in the short term will continue to go down. But the currency is going to get devalued. That's the only way for it to happen. But the Japanese stock market then has correspondingly been going up. So the Keynesians see this as great. All we got to do is devalue the currency, stocks go up, our corporations are making a lot more money, the bond yields are lower, so the interest payments we make are even lower, right? And for the short term, this looks great. But this is, increased the amount of debt on the central bank's balance sheet by even more. So eventually this is going to break. I don't know exactly when. If I had to give you a good guesstimate, I would say sometime in the next 3 years. It's just going to happen. So what will most likely happen then, Raul, is that the yen is just it's gonna go from like 100. The yen's already been massively devalued against the U.S. dollar and the euro. Just in literally the last 12 to 18 months, massive devaluation, over 25.
20%, right?
Yeah, over 25%, I believe. I think against the euro, it's even more. The yen's been devalued even more against the euro than it has against the dollar, and it's been devalued a lot against the dollar. So basically, then in the next 3 to 5 years, Raul, you might see a situation because of all this QE. By the way, the Japanese central bank announced that they're going to expand their base money supply, quadruple it. So what this is going to allow then is if you're a hedge fund manager in New York or London or something like that, you can borrow 10 million yen, 20 million yen, a large amount of yen for 10 years at 17 basis points or something. It's going to create an even more global carry trade. So basically then, the yen is going to, not only is it going to fuel the Japanese stock market going higher, at least on a temporary basis nominal, not really because of fundamentals, but it's also going to start fueling other asset markets all over the world to go higher, because people are going to borrow, smart, savvy hedge fund traders are going to borrow almost zero interest rate money from the Bank of Japan or a Japanese bank there that's going to lend them the money, and they're going to put it in U.S. dividend stocks. They're going to put it in things like that. So we're going to have an even more magnified situation. The yen is eventually going to break, though. It's near guaranteed. It's near guaranteed. The yen has already started to show cracks. So basically then, this trade, if it takes a break, let's say if the yen goes to like back up to 90 or 85 or something like that, like people start closing out the trade, that's not going to be permanent. They want the yen devalued against the dollar. I don't see the Fed wanting to really stop this against the yen. I think the Federal Reserve, is more concerned right now with the euro and propping up the euro, because there's been a lot of backdoor bailouts of European banks. Those European banks are more connected to American banks. So the Fed is more concerned with printing a lot of money, like currency swaps and other backdoor bailouts, and saving the ECB and saving the large European banks and propping up the euro so they can devalue the dollar that way. That's more the Fed's concern. They're not really looking at the Japan thing right now. I don't think they're too worried about it.
The thing is, though, if you look at the recessions in the past, if you look at 2007, 2008, if you look at what happened in the 90s, you saw the yen carry trade. You saw all this, not selling, but you saw all this buying back of the Japanese yen. They were closing out their positions, and what you said before, if you see it closing out of the positions in the short term, you could see it go back to 85 or 90. But you had the carry trade go away, and initially, could you see the yen going back to, I don't know, 80, 82, maybe 75, and then all of a sudden you just see a crazy devaluation of the yen? Because every time you have a recession, I've noticed the last 2 times, you have seen the yen strengthen.
It's always a possibility, Raul, because in the past that's what it's done. But to counter that point that you just said, the Japanese central bank has not been nearly as aggressive in the past as they have right now. They have not in the past announced that they're going to quadruple the money supply, which I believe they're going to do by 2014, 2015. I think the money supply, the base money supply, is going from 13 trillion yen to 60 trillion yen. So that's a humongous increase in the base money supply. Now, obviously, I don't know if the Japanese banks are going to lend it out, but if hedge fund traders are going to start using the carry trade, they're going to increase the money supply that way, and that money is going to start going through the global economy, through commodities markets and asset prices. So, I mean, what the Keynesians have done, Raul, and this is all a global wealth effect, part of the liquidity-driven bull market, is the Keynesians have not really fixed the real economy. They think it can, in theory, and they believe in like the trickle down with the wealth effect. The Keynesians have created really humongous inflation in asset prices. Humongous. I mean, across the board. The real estate bubble here in the United States, in Canada, in some other countries, the real estate bubble in the United States has been reinflated. There's a real estate bubble in Canada. This is all thanks to global central bank policy. It's not just the Fed. So these guys, I really don't see anything to stop the global asset price inflation. I don't see anyone willing to take away the printing press from all the central banks. Surprisingly, gold really hasn't gone up that much yet. It's been in correction mode. But I think the physical demand for gold has put a bottom in the market. It's either that or the miners are going to go bankrupt, and then we're going to have a breathtaking supply shock 3 to 5 years from now, because I don't see physical demand for precious metals decreasing. In fact, it increased very rapidly on the paper price smackdowns on April 12th and April 16th. Demand for physical has never been stronger. These are types of things really that you haven't seen since 2008. I was kind of in the market buying some physical after the 2008 crash, and there were massive wait times, and people really couldn't get stuff near spot price with low premiums without buying 1,000-ounce bars and things like that. So for regular people, they were waiting many weeks. The premiums were really high. Many weeks to get delivery. Premiums were really high. We're starting to see that again. So we're at a tipping point here. The commodity markets are the one asset class for literally the last 2 years, Raul, that have not participated in this global asset price inflation. They've just gone smacked. Now, the commodities, some of the commodities, the industrial ones, are more tied to real-world economic growth, but surprisingly, the precious metals have not acted the way they're supposed to. And that leads me to believe, like I said, that comes down to manipulation. Because why isn't the market acting the way it's supposed to? Why are things doing this and this and this when they're not supposed to be doing this and this and this and this and this? So, it just boggles the mind. Now, there is a lot of money, like I said, chasing yield. And gold does not offer, physical gold does not offer the yield that many people need. So people right now are putting their money into cash flow real estate. They're putting their money into dividend stocks. Maybe they're still buying some bonds, although I think that's the worst market to be in besides holding cash in the long term. I mean, people should hold some cash in the short term, but they should not hold cash in the long term. But, when the commodity prices, when the producers, the miners, these guys have been inefficient for a while in some commodity industries, although the oil and gas industry has probably been the best of the bunch because they have the best dividend yields. But the other miners, and the mining is more difficult, these guys have not run their business operations efficiently. But as things improve that way, I think at these bargains, I think people are going to be able to make those multiple 100% gains in the future if they're patient, if they buy the right companies, like you talked about earlier in the interview.
I wanted to end on one thing, and you're talking about manipulation. Ron Paul did a few interviews this past week, and he stated that in his eyes, this was due to manipulation. Some people don't believe it. He said that there obviously is some price fixing going on. He thinks that the Treasury is involved. And tying this back to the 70s, he said that the similar situation happened where you had the price of gold went from $1.99 an ounce to $110 an ounce, but then no longer the Federal Reserve or central banks could no longer, how should I say it, continue this price fixing, and then you saw this super spike in the 70s, and I believe that the same thing is most likely going to happen this time around. I don't know the time frame, though. But before I let you go, Jason, how can people follow your work again?
Sure. They can go to our main Wall Street for Main Street website, which is WALLSTFORMAINST.com. And we also do a lot of podcast interviews with top money managers, economic experts, paid newsletter writers, things like that. And we do paid consulting work. So if your listeners want to learn how to fish for themselves, they want to learn how to find those good undervalued dividend stocks of smaller companies, because some of the larger dividend-paying companies tend to be a little bit more overvalued because a lot of capital has already flowed into them. We can teach your listeners how to find good dividend stocks. We can teach your listeners how to find the best of the best resource stocks. So we're more of a teaching company, and we pride ourselves on top-quality research and teaching people how to fish for themselves rather than just giving them fish.
Indeed. And thanks for coming on again, Jason.
You're welcome. And hopefully gold and silver will be a lot higher next time, so we don't have to talk as much about negative things.
Hopefully. All right. Thanks again, Jason.
Okay, bye.